Hello, everyone. Welcome to TaxAid training for filing season 2025. This is volunteer training for experienced and new volunteers. And the topic I'm going to cover today is what's new for tax year 2024. Generally, we're going to cover issues and updates that typically impact our clients out on the field. And I wanted first to thank each and every one of you for volunteering with us this year. My name is Andy Chang. I'm a site manager. I've been at the Fair Oaks site in Redwood City. I've been involved with TaxAid for about 20 years now, and my daily job is a CPA. So I'm very happy to be here and very happy to present to you guys what's new for 2025. So let's get started. A couple of housekeeping items first. Nothing in this summary, this deck here, should be construed as legal or tax advice. This is just basic information that I'm presenting, and it cannot replace actual tax advice with a CPA or a lawyer. Additional information about tax law, however, may be found on the IRS's website. Okay, our agenda for this presentation, we're going to go over what's new for tax year 2024. We're going to talk a little bit about new provisions. We're going to talk about changes, tax law changes, form changes, tax form changes. We're going to go over some reminders for the filing season and when folks are out on the field. Yeah, just high level, there hasn't been wholesale changes to the tax law for this year. We might expect that starting next year, however. But there are some key changes that are generally to our taxpayers' benefit. So we'll go over them in the next few slides. All right. The filing deadline for tax year 2024, again, is April 15, 2025. That date is a Tuesday. So no weekends to extend by a couple of days, as we've seen it in prior years. The income threshold for for earned income tax credit recipients is now $67,000. So that should be viewed as the filing threshold, the maximum gross income threshold for our clients. So if you have reviewers or if you have intake folks that are talking to the clients as they're coming onto your sites, just make sure that they count up all of their W-2, their 1099s, just to make sure that they don't exceed the $67,000 threshold. Okay, so for our clients that drive for their business, the new standard mileage rate is 67 cents per mile. And then for medical expenses to be deducted on Schedule A, that's 21 cents per mile. For miles driven for charitable work, that's now at 14 cents per mile. Okay. Form publication changes. So the 1040 now, the tax year 2024 1040 now has a field under filing status, and it's a checkbox for taxpayers that have a non-resident or dual citizen spouses. And if they want that spouse to count as a U.S. resident for the year, that box will need to be checked. On the Schedule 1 of the 1040, there's now a box or a line for additional adjustments for taxpayers that receive the 1099-K from a Venmo or PayPal. We'll go over the specifics of a little bit later. But if there's amounts reported on the 1099-K that are received in error, or if they had a personal item that was sold at a loss, personal items sold at a loss is not deductible, so those amounts should not be included on the tax return. And so now there's a line to make that adjustment. On the W-2, there's now a new Box 12 code for Medicare waiver payments that are excludable from income. So this typically, we'll see this with in-home supportive services, folks who provide long-term care or care at someone's home because either they're age, blind, or disabled. Those service providers will receive a W-2 now with a box code, Box 12, two big I's. That field is critically important to enter correctly into Lacert because that will render all of the income as tax exempt. So, before we used to hard code those zeros into the W-2, we no longer have to do that. There's now the Box 12 code. And finally, back to the 1099-K. So these are forms you would receive if you received credit card payments or if you receive payments on a Venmo or a PayPal platform. If you receive more than $5,000 of proceeds from the 1099 from these platforms, they will send you 1099-K. Okay, next. Okay, we had some changes to some form publications. The first two, Pub 1244 and 531, deals with reporting tip income. If your taxpayer is in the services industry and receives tip income, there are rules on how to do daily reporting, how to do record keeping, and when they have to report those tips to their employer so they get proper payroll withholding on them. There used to be two publications governing it. Now there's only one. 1244 is now superseded and completely replaced. It will no longer be updated. The Pub 531 is now the governing document. The Form 5329, this is an additional 10% tax on any early withdrawals from a qualified plan, such as an IRA. There are now two new codes, which provides an exception to the 10% penalty. And we'll go over those in a little more detail, but it has to do with distributions related to a domestic abuse victim and or a distribution made to an emergency personal expense. The Form 8888, this dictates the allocation of a taxpayer's refund. Now you can use the Form 8888 to specify how much of the refund should go through direct deposit and how much should be issued via paper check. Okay, so we'll go over some details on the those exemptions, those new exceptions for the 10%, waivers from the 10% penalty for early withdrawal from your IRA. The first one is the emergency personal expense. If you have an emergency personal expense, you can pull out as much as $1,000 from your IRA, tax-free as long as, or free from the 10% penalty as long as it's repaid within 3 years. Let's skip to the third bullet point here. For domestic abuse victims, they can distribute up to the lesser of $10,000 or 50% of the accrued benefit from an eligible retirement plan without the 10% penalty. The distribution still has to be repaid within 3 years of the distribution. Okay. And then for any taxpayers that are Section 529 plan beneficiaries, these are the education plans. Generally speaking, it's only tax-free if they use it for qualifying educational expenses. However, if the 529 plan is not used for qualifying tuition, they're still able to. Those beneficiaries are still able to roll them into a Roth IRA tax-free as long as they meet certain conditions, including the fund has to be at least 15 years old. Okay. Okay. Standard deductions for 2020 tax year 2024, they've increased about 5%, and the grid on the slide shows the exact amount for each one. The changes, the child tax credit, this is a credit that many of our clients that have qualified children would be eligible for. One of the main rules here is the qualifying child needs to be 17 or younger at the end of 2024 in order to be a qualifying child. The amount is still $2,000 per qualifying child, but $1,700 of that credit is refundable. So your taxpayer doesn't even need to have tax liability through the year in order to monetize a large portion of this credit. Couple of reminders here. So the personal, spousal, and dependent exemptions remain suspended on $0. And if you have a taxpayer that wants to claim a non-child as a dependent, that qualifying relative cannot have income more than $5,050 for the year. Okay, so educator expenses are above the line deductions. We usually put that on Schedule 1. That deduction has now increased to $300. These are for teachers that have out-of-pocket expenses. The kiddie tax. So for taxpayers with children or minors that have passive income, they can be hit with the kiddie tax if that passive income or unearned income is more than $2,600 for 2024. Okay. As mentioned earlier, there were changes to the 1099-K filing thresholds. Bottom line is, if you receive more than $5,000 from one of these third-party settlement organizations such as Venmo or PayPal, your taxpayer is going to get a 1099-K if that amount exceeds $5,000 for tax 2024, and then for tax year 2025 that ramps down to $2,500, and then ultimately should settle at $600 for tax year 2026, just to stay in line with the filing threshold of like a 1099 miscellaneous. Let's talk a little bit about charitable distributions out of a retirement accounts, such as an IRA. In 2024, the maximum amount of qualified charitable distribution that won't be taxable is $105,000. We probably won't see that with our client base because it does require a distribution over $100,000. The retirement savings contribution credit, or otherwise known as the savers credit, for individuals or families that low income but are making contributions into a retirement account. There's an additional credit for them. It starts to phase out if their income is above $38,000 for single, or $76,000 if they're filing jointly. The IRA deduction amount for contributions into a IRA account is now $7,000, $8,000 if your taxpayer is over 50, age 50. There are now slightly complicated rules if your taxpayer is also covered with a retirement plan at work, such as a 401k. That $7,000 IRA deduction limit decreases or phases out if they have income or MAGI of more than $123,000 if a joint return, or $77,000 if single. Okay. Even more complicated is if you have a taxpayer that is who is self-employed or not employed, but has a spouse that is employed by an employer that has a qualifying retirement plan. There are rules about what the IRA deduction should be if the household has more than MAGI of over 146,000, or that likely won't apply to any of our clients because, again, our filing threshold is at 67,000. So I'm going to not spend too much time on this slide. Okay, a QBI deduction. So these are deductions available for folks who have sole proprietor, self-employed income, or income coming through a partnership entity. There is a 20% deduction available for them, but it phases out if there is more than $383,000 of income. Again, probably won't apply to any of our clients. The student loan interest deduction, this is the above the line deduction that we take on the Schedule 1. The phase out for that deduction starts at MAGI of more than $80,000. But again, we shouldn't see that limit kick in for your typical tax aid client. Okay. The premium tax credit, again, this is the credit available for folks who purchase health insurance on the marketplace under the ACA. There is a repayment threshold, and the thresholds are listed in the grid below. For tax year 2025, taxpayers with annual income that exceeds 400% of the federal poverty line may also be allowed a premium tax credit. The health savings deductions, so these are contributions into a health savings account. That deduction for 2025 has now increased to $4,150 if you're just covering them, just the individual, or if there's a family coverage, the contribution limit jumps to $8,300. And then for taxpayers that are over 55, there's an additional $1,000 on top of that. for taxpayers that pay into an insurance program for long-term care, those premiums are eligible as qualified medical expenses deductible on your Schedule A if your taxpayer is itemizing. And the chart down below tells you the maximum amount of deduction, and it's dependent on the taxpayer's age. Let's now jump to the Earned Income Tax Credit. Again, this credit is critically important for TaxAid. This is one of the reasons we exist to help taxpayers that are eligible for this credit actually file and monetize the credit. There is a general prohibition though on earning so-called passive income, unearned income. That limit for 2024 is now 11,600. So just make sure your taxpayer isn't reporting like interest income on interest or dividend income amount, and they'd still be eligible for the earned income tax credit if their earned income is low enough. And then we talked about the IHSS workers. Again, their income is tax exempt. There should be a new code on the W-2 for that type of income. But just because it is tax exempt doesn't mean they're not eligible. Those taxpayers are still eligible for their income tax credit. So again, it's critically important that you enter their W-2 income correctly in order for the earned income credit to populate. Okay. And then the maximum AGI limits in order to be eligible for the earned income tax credit. The amounts are listed here, the grid below, and it's organized again by the amount of qualified children the taxpayer has. Okay. And then the maximum earned income credit you should see on the 1040 for a taxpayer with at least 3 qualifying children should be $7,830. So we shouldn't see an amount on the EITC line more than that. Okay. And finally, we have a California credit for individuals that have passed through the foster youth program. This is a credit for folks who are between the ages of 18 and 25. They must have gone through the foster youth system at 13 or older, and the credit for them, and it's a refundable credit, which is better. The credit is $1,117, and we claim that on the California Form 3514. And that concludes our presentation for tax changes for tax year 2024. Yeah, my name is Andy. I'll be supporting the Fair Oaks site this year. Thank you again very much for volunteering your time. This is a great cause that you guys are supporting. And yeah, I look forward to seeing you guys out there on the field.